Right. Happy Friday, everybody. It is 3:15 p.m. Eastern Time and Friday, and that means it's my favorite time of the week, my Friday afternoon live stream, when I get to talk to all you fine folks about everything going on in the world of economics and finance. And there's no shortage of happenings going on today, or this week, I should say. It has been a week, hasn't it? We had a monster rally in Bitcoin this week. Talk a little bit about that. And I read an interesting theory today about what might be behind that. Talk a little bit about that. But the top story, the big one this week, has been central banks, in particular Western central banks. They struck an unusually, I shouldn't say unusually, but a particularly hawkish tone this week. We had Powell testifying in front of both the House and the Senate this week. And both series of testimonies, he reiterated that they are not done with their rate hikes, and that they are very likely, they're data dependent, and they feel our pain and all that typical stuff. But the message was another hike is coming in July, maybe two more this year. And so with that particularly hawkish tone, combined with a surprise 50 basis point hike from the Bank of England, we also had some hawkish maneuvers coming from Norway and Swedish central banks, not to mention that 650 basis point hike from Turkey yesterday. Particularly hawkish tones from central banks. And so the message to stock markets, the message to equities has been, yo, FOMO bros. There's more pain coming. Higher interest rates coming. I get it. Tesla, moon, yay. But guys, think about it. All of the bearish sentiment that's built up in markets right now, all of the narratives about what could potentially bring this market lower, they're all tied to hawkish central banks and interest rates, right? Bank failures were driven by unrealized losses in U.S. treasuries. We've got the commercial real estate bubble, something we'll talk about a little bit today. It's all tied to higher interest rates. Companies going into default, companies struggling to raise capital, companies struggling to keep their employees, especially cash burning growth companies in tech, struggling to get access to capital. Venture capital is drying up, especially after Silicon Valley failed. This all centers around central banks and their hawkish interest rate hikes. And Powell said there's more coming this week. And he had to say it a couple times, but eventually markets got the message and stocks headed lower this week. Now, I talked a week ago on Friday was like my ultimate bear case live stream. I mean, I was sitting here just in disbelief watching markets grind higher day in and day out. And I made the case last week like, hey, guys, this market is looking toppy here. Valuations are at historical highs. We've got this fear-greed index in extreme greed territory. We're really shaping up for a bottom to fall out pretty soon. And it looks like we may have started that this week. The hawkish sentiment from central banks may have triggered a correction in this FOMO rally. Now, we don't know. Is this going to be a correction? Or is it going to be a short pullback, a few hundred points? Maybe Monday comes and we just shoot right back up. 0 days to expiration options pile in. Firms have to delta hedge. They buy the shares and up we go. Or maybe we're into another correction, a 10% pullback before resuming higher in this bull market, this new bull market. Or maybe we're heading into a new bear market, or maybe the big one is finally here. All these things are possibilities right now. All I know is it really looks like that may have started this week. Now, before we get into all of that magnificent news going on, I have to say a quick thank you to the sponsor of this stream today, Patriot Gold. Thank you, Patriot Gold, for your sponsorship, guys. What is the message we're getting from central banks? Western central banks are saying there is more pain ahead in equities. They're saying watch out for those risk assets. Eastern central banks are saying we love gold. They are buying it up hand over fist. Imports of gold, especially into Eastern countries and by their central banks, is spiking, and this has been going on for several years now. So the message is pretty clear from our central bankers that they're not done making things worse. And so a great way to protect yourself from them is with the ownership of physical precious metals. And that's why I like Patriot Gold Group. So call 888-988-5401 or use the link that is right down in the description here. Go to nsfgold.com, ask for your free investor's guide, and of course, tell them that nobody sent you. And with that, we're going to shrink my big melon of a head. Let's bring in my man Mish here and see what is going on today. Mish, how we doing today, brother?
And I'm doing great. It's kind of cloudy here, but it's still a nice day out.
Awesome. Yeah, I don't know if you guys can hear it, but it's raining pretty hard where I am right now. I got the sound of raindrops all around me on the roof, so I got to warn you, my internet gets a little bit wonky in inclement weather out here. I live in rural PA. But for now, we're doing okay. But we need the rain. That drought is over. What do you think going on today, man? What do you think about this central banks and their hawkish tone this week? Am I interpreting their message?
Yeah, it has been really crazy because you had Bank of England come out with that 50. Several ECB people said, "Hey, we're going to continue rising. Let's deal with it." And so you have that. Even the Australian bank, the Royal Canadian Bank, the Australian Bank, they're all like in this tightening cycle. The Eastern banks, Japan, China, those I use Australia as a Western because of the type of government and whatnot, right?
Yep.
They're more closely associated with England. So then you have the Southeast Asia banks, and they're all loosening right now. So you've got this weird dichotomy going on.
Yeah, we did. We saw, Japan maintained their loose monetary policy last week. A lot of people expected that new BOJ governor Ueda to come in and, myself included, to come in and start tightening right away. He hasn't done that. I think the U.S. bank failures and Credit Suisse back in March and May, I think that probably spooked Japan. When you're watching banks fail, it's probably not the time to pivot tightening. Um, and then, of course, the PBOC has been loosening, almost on a weekly basis. It's been a few days since we got any policy support from China, but they're still grasping or grappling with their property bubble collapse and the lackluster reopening going on over there. You can see that in the oil markets too. Something else we'll talk about a little bit today. But yeah, you've got Western banks are still tightening. They're tightening into ever shrinking inflation. I mean, inflation is falling fast in the West. I know core inflation is stubbornly higher. It's not falling as fast as they'd like, but we were just talking before we went live. Oil prices are falling pretty fast. We're down in the high 60s again. And oil tends to have a dragging effect on other prices, right? It was in late 2021 when oil prices started to rally ahead of the Russian action in Ukraine. That's when inflation really kicked into high gear because oil prices moving higher dragged everything up with it. Now we have the opposite happening. We've got oil prices heading lower, dragging core inflation down with it slowly. But you can usually look to the signal in oil for what the other inflation statistics are going to do. And right now, oil and headline inflation is very low, even though core is sticky high. So my personal opinion, Western central banks are making a mistake here. I think they're over tightening. They've already over tightened. And, right now we're still waiting for those 75 basis point rate hikes to turn 1 year old. And when that happens, watch out.
I'm also waiting for the yen is now heading back towards where it was in October when they were just pounding money into it. It's in 143 to the dollar right now. And I think they let it get to 145 last year before they started pounding it. So that is actually
JPY, right?
Yeah.
Yep.
So that is actually causing the Dixie to drift up when others are pushing us down. So that and the Frank's getting kind of wonky, but so yeah, you see the yen here. It's getting close to where that max was last year.
Yeah, I mean your intraday high was about 151.8. It looks like the closing high was about 150. So we're getting to that point where Japan would start dumping U.S. treasuries to get dollars in order to dump those dollars to prop up their yen. And we're at 143 right now, up from a low of about 127 earlier this year. So yeah, we're pretty close to that point where they start taking action to prop up the yen over in Japan. And I think the yen is the number 2 or 3 contributor to the Dixie math. I know the euro is the biggest. I don't know if yen or the loonie is number 2 or the pound, but it's a big one. So that's a good point. We're getting pretty close there.
So when they start driving that down, that means the Dixie's going to go down fast. So
yes,
we could see it go to sub 100 within a week.
And let's look at the Dixie chart. When did they start defending the yen? That was Friday, October 21st of last year. Let's go to the Dixie chart here. And when was the high? The high in the Dixie. Okay, it wasn't quite the high. The high on the Dixie was intraday September 28th. But it was a week later or a month later. We were still up in that area, 112 to 114 range when Japan started defending. And that's when this cascade down in the dollar started, when we went from a high of around 114 to as low as 100 We've retested that level a couple of times. We're a little bit higher now. I think the hawkish tone from Powell this week breathed a little bit of life into the Dixie, currently at 102.9. But yeah, I mean, we're defending action from the Japanese central bank could be something that sends us below this 100 level on the DXY that we've retested a few times now. That's something to watch for. All right, let's look at what's going on in markets right now. First of all, we had a down week. Markets were lower virtually all week. Yesterday they had a nice rally, but they gave up almost all of that today. The CNN Fear Greed Index is still at 74, right on the border between greed and extreme greed. All right, so if you think this sell-off is done, not really. All right, looking at the timeline here, this is going back about a year to what the Fear Greed Index has done. Yeah, we're off our highs, but look at the last few times we were at anywhere near this level, right? It typically pulls back at least below 50, typically down into the 30s. At some point, we were down, almost to below 20. We were at 13 in September. All right, so markets could head significantly lower from here. I'm not saying they will, but we are still much closer to a top than a bottom, at least according to this indicator. S&P right now is down 35 points or 0.8%, just off the lows of the day at 43.46. Looking at the week that the S&P has had, let's see, we started the week, where was the Friday close? So we closed on Friday at about 44, right around 4,400 on the S&P, and right now we are at 43.47. So the S&P lost a little over 100 points on the week, so pretty significant down week, and it was spread out across the whole week. I know we had a little bit of a rally yesterday. Looking over at the Dow, down 227 right now, again, just off the lows of the day, down 0.2% at 33,719. Let's see what the Dow did this week. Again, we got the close on Friday at 34,300, currently at 33.7. So, almost a 600-point sell-off in the Dow this week. Nothing to sneeze at. And the NASDAQ is currently down 136 points, 1%. Again, just off the lows of the day, but a pretty significant down day right now, giving up everything it gained yesterday. Looking at the weekly chart, the NASDAQ has had quite a week. We closed on Friday. Where's the Friday close? Uh-oh, I got to zoom out a little more. Okay. Here's the Friday close. We sold off into the close. We closed around 13,680, currently at 13,005. So we lost almost 200 points in the NASDAQ this week. And now I want to show you something on the NASDAQ I saw today. It looks like we may be about to close a head and shoulders pattern here. It's not definitive, but I'm seeing something like a neckline around 13,450. We bounced off that level today. So this hasn't completed yet. We're still right around the neckline. But if that completes, we're looking at a downside target on the NASDAQ somewhere around 13,050. So keep an eye on that pattern. Keep an eye on that 13,450 level, roughly. A close below that would be a very bearish signal for tech, in my opinion. And with everything we heard from Powell, and with prospects for another rate hike in July, I have no reason to think, other than number go up, that we won't hit that. Before we go any further into the indexes, I got a thank you I got to send to, who's that? We got Mr. AK is here. Thank you, AK, for the super chat, sir. I appreciate the support of the channel. And he's saying it's a bull market for SQQQ, so short from 15,150 NASDAQ. It sounds, look at you go on TradingView, much easier, isn't it? Hey, look, on TradingView, I got to send a shout out to my buddy Brian Zarb. I've had him on the channel a couple times. It's actually been a while since we had Brian on. I should bring him back in soon. Brian took time out of his day, which is not easy because he lives in Malta, so he's on the other side of the world. He worked around my schedule, and he set aside a couple of hours, and we went on a Zoom call, and he showed me TradingView. It was incredibly nice of him. He didn't ask anything in return. He's just a really nice guy who wanted to help. So shout out to Brian. That's why I'm on TradingView right now. And it was something I'd always been meaning to do. It's just I never had time to go sit down and learn it. And so Brian spent a lot of time with me. I could still learn a lot. TradingView is an incredibly powerful tool. I just after a couple hours of rudimentary instruction from Brian is why I'm doing what I'm doing now. Funny you should mention SQQQ. Last week before I went live, I did buy some calls in SQQQ. They're doing okay right now. I added to that position this week. So we'll see. Did Jack step in a bear trap? Or are we heading lower? Did I call the top? Only time will tell. But, Perma Bear Jack betting against the market, I guess, that's nothing too big there. I rarely do optimism, but at this point, I really do think we're very close to a top, at least a short-term top. Again, I don't know if this is the big one and we're going to go down big from here, but we're at least looking at a correction, I think. So thank you very much, AK. I appreciate the super chat, sir, the support of the channel. Now, what is he saying? So you're short from 15,150 on the NASDAQ. Did we even get that high? Where's 15? No, we didn't even get that high. Not sure what you're saying here. So short from 15,150 NASDAQ, it sounds. Anyways, having trouble interpreting the numbers there, AK, but I am short the NASDAQ. That's about all I can tell you there. But thanks again, brother. I appreciate the super chat, sir. I appreciate the support of the channel. And let's move on here, shall we? We were on the NASDAQ, back on the DXY. We already talked about that. Dixie's up 50 basis points today. Pretty good day for the dollar. It's currently at 102.89. We did break above 103 early this morning, but we gave that up, and we've been kind of bouncing around ever since. Again, I looked at the long term. We're not going to revisit the long-term chart on the DXY. Yields are mostly lower today. We got the 10-year is just barely lower. We were down almost 10 basis points at one point this morning on the 10-year. Now we're at 3 points. Go ahead.
Somebody started selling the 10-year because if you look at it, it's different than everybody around it.
Yeah, we got the 10 years only down 1 basis point, but it's bracketed by 5 basis point moves in the 7 and the 20. That's interesting. We've also got the 2 is down almost 6 basis points. So, yeah, that's a interesting behavior in the 10-year yield there at this point. Currently yielding 3.74. Let's look over at commodities. And, one reason I said this morning that I thought what we were seeing this sell-off this week, that it didn't really strike me as a fear trade, was because precious metals weren't participating. And, of course, as soon as I opened my big mouth this morning, silver started to rally. It was up, I think, 30 cents at one point. It gave up all that. And now we're pretty much right back where we opened today with gold up $6, silver up 2 cents. If this was really a fear trade setting in and not just portfolio rebalancing or end of quarter shuffling of the big funds and the big money managers, if this was a legitimate fear trade, we'd see precious metals getting in on the action, right? We're seeing interest rates lower, we're seeing stocks lower, right? So that's typical of a move from stocks to bonds, which is a fear trade. But if it was legit fear, we'd see gold going up with it. We're not. So I think this is just portfolio rebalancing right now. Now, crude oil down 32 cents. It was down over $2 at one point this morning. Still below 70 at 69.19, down about 0.5% today. Let's look at the oil chart right now. Now, something I'm noticing here, we were just talking about this before, Mish. Oil looks like it's really trying to put in a bottom, right? Somewhere around here in the mid-high 60s. Oil's trying to put in a bottom, but it also looks a lot like what it was trying to do a few months ago when oil was trying to put in a bottom in the low 70s, right? We saw the same thing here. Oil came down. It was looking for a bottom in the low 70s. It tested once, twice, 3 times. Eventually, it broke down below it. Now here we are testing another new low in the mid 60s. We got 1, 2, 3, 4. Today was five times testing these recent lows in the mid 60s. Now the one reason I'm not calling a bottom in oil yet, but it feels bottomy here, is because of these 2 consecutive cuts from OPEC. I think OPEC is sending a message to the Biden administration: you better start refilling the SPR because you're not going to get the oil any cheaper. And if you don't refill the SPR to support prices where we're at, we will continue to cut production to keep prices where they're at. And then that's dangerous for you. Now, the reason that's dangerous is right now, we have so many million barrels a day. What is it, like 20 million barrels a day of production? Something like that. So if we go to refill the SPR, there's still enough oil moving around where we could start refilling the SPR slowly without causing a big spike in oil prices. Now, what if we wait another year or 2 years, or what if Biden does the ultimate middle finger to his successor and decides he's not going to refill the SPR at all until he'll let the next guy worry about it? Well, we could have several more of these million barrel production cuts from OPEC Plus to the point where when they finally do start refilling the Strategic Petroleum Reserve, we're refilling from a much less liquid market where now buying the SPR represents a much bigger share of the oil that's available on the market, and it does cause a big price swing. So the message Saudi Arabia is sending to the Biden administration is you better or get off the pot here, because if you don't start refilling that strategic petroleum reserve soon, you're going to have a big problem when you go to do it, because it's going to cause a spike in prices, and we will not increase production to offset that when it happens. And I think Biden's starting to get that message. Was it 2 weeks ago that they announced, I think they're going to start. It was a very small purchase. It was only like, I think, 3 million barrels or something. Like, oh yeah, we only have to do that.
3 million barrels in August.
3 million barrels in August. So yeah, we only need to do that, 80 more times, and we can refill or replace, or 60 more times, and we can replace all the oil that they sold last year. It was 180 million barrels they sold last year in that one big dump. So yeah, we've got 1/80th of the oil we need to replace 2022's dumping. At that rate, hey, we'll all be old men, or maybe even dirt by the time they actually finish refilling it. But at least they've started. I think the Biden administration has kind of sent the message to Saudi Arabia, okay, please stop cutting production. We'll start buying at least a little bit. So both of those actions, the Saudi price cuts and the refilling of the SPR, they're going to serve to put a floor on oil prices here, or at least try to put a floor in, right? If these slowdowns in these global PMIs, and if global trade keeps contracting the way it is, then it doesn't matter how much oil they buy in the SPR, and it doesn't matter how much the Saudis cut production, we're going to have lower oil prices. So, we do need industry to somewhat stabilize here. If it keeps declining like it is, then oil's headed lower. And something else to watch out for. Now, this is actually something that tells me, hey, maybe oil is getting bottomy here. This is the Baker Hughes oil rig count. Another decline this week. This data point just hit the tape a few minutes ago here. Another 6 oil rigs shut down in the United States this week. And we're losing oil rigs week after week here, guys. I mean, look at this decline going back into April. We were at 591 a few months ago. And, we're just shutting down more wells. And as these wells shut down, as these rigs shut down, there are not new ones coming online to replace them. So domestic oil production is struggling at these price levels. As these rigs shut down, that's less supply coming into the market in the U.S. So this is something else that's helping to put a bottom in on oil prices. As these prices, the longer they stay down here, more of these unprofitable rigs are going to shut down. It's going to limit supply, and it's going to put upward pressure on prices. But this is dangerous because this is our domestic production slowing down. You don't just spin this right back up, right? Let's say we keep shutting these things down. We keep losing 6 a week for another year or so. We could be at a point where U.S. oil production is a fraction to where it was, and then say there's another oil embargo or some disruption to global trade happens. These rigs don't just come right back online. Like, look at a 5-year chart here. Here's the big shutdown when prices went negative in 2020, right? We're still not back up to those levels, even though oil prices went over $130 a barrel at one point. Those rigs don't just come back online. It's not that easy. It takes a long time to bring that production back online. So as this chart rolls over, as we continue heading lower, our energy situation is becoming more precarious. This is, we're giving up some of that energy independence that we had achieved. So that's something to keep an eye on there. And here's the main story that I wanted to talk about today, guys. Central banks to Wall Street, more pain is coming. This is on your least favorite news network, if you will, this morning, but this was actually a pretty decent article. Let me zoom in a little bit, make it a little bigger. Market euphoria in early June, spurred on by a pause in interest rate hikes by the Federal Reserve, is well behind us now. Market euphoria. Interesting. That return to normal phase, right? It's well behind us now. Central bank leaders in the U.S. and across the globe delivered a clear message to markets this week. We're not done hiking. Wall Street didn't take the message well. U.S. stocks are on track to notch a losing week, and the NASDAQ is on pace to end an 8-week winning streak. It's been just over a week since the Federal Reserve paused its 14-month regimen of interest rate hikes to fight inflation. Now it appears that pause will be very short-lived because Fed Chair Jerome Powell testified before the House and Senate this week that the central bank is far from reaching its 2% inflation target and expects to hike rates further. Let me sneak past the quote here, and we'll say the Bank of England, meanwhile, surprised investors by raising interest rates in the UK by an outsized 0.5 percentage point or 50 basis points. Analysts had expected a smaller move. In a statement, the BOE policymakers said that economic data showed that inflation was proving persistent as the labor market remained tight and consumer demand strong. I think this is a mistake. I really do. I've been talking a lot on this channel about how I think deflation is coming. And the longer they fight inflation, the faster and harder the deflation is going to come on. Central banks have been making smaller interest rate moves as inflation began to ease off of recent highs. However, that no longer seems to be the case. Elsewhere in Europe, central banks in Norway and Switzerland also hiked rates to decade-high levels on Thursday. Officials in Norway said rates will most likely be raised further in August, and Switzerland also indicated that more tightening is coming. So you got a lot of Western central banks here raising rates, guys. Why that matters: in the United States, markets have been enjoying a bull run, largely fueled by a boom in tech stocks, which are particularly sensitive to inflation and interest rates. And news of a return to hawkish monetary policy could put an end to that. Stocks rebounded slightly on Thursday, but investors seem to be slow to come to grips with the likelihood that rates will be higher for longer, according to Scott Wren, senior global market strategist at Wells Fargo. Rising rates weigh on both economic growth. The Fed wants and needs to see slower growth in demand and financial markets, wrote analysts at financial firm Commonwealth. This potential headwind will be something to watch closely for the rest of the year. So, clear message from central banks, and maybe the FOMO bros aren't really getting that message, but they'll see that message in red very soon. This is saying, you guys who are FOMOing into Tesla calls and NVIDIA calls because number go up and stocks only ever go up. It's not going to be the case for much longer, or really, it hasn't been the case since the start of the week, or really since the close last week. We sold off pretty hard in the close last Friday. And thank you to Mr. Steve Whitus, sir. He says, renewed mortgage today at 5.09% fixed rate, was 1.5% variable 16 months ago. 333% more interest, or $9,000 a year more interest. No extra spending for me. Steve, are you in the UK? Is that where you are? You had a variable rate 1.5% mortgage. I'm wondering, what drove you to refi? Did you have to because the teaser rate expired on your rate? I know a lot of countries here in the U.S. We've got the 30-year fixed rate mortgages. Most people, once you lock in a 30-year mortgage at 2.5%, you're going to cling to that thing. I mean, they'll pry that low mortgage rate from my cold dead hands. You know what I mean? But I know in a lot of other countries,
ain't happening.
What's that, Mish?
I'm at 2.5%. Ain't happening.
2.5. That is a beautiful thing. I mean, why would you ever repay 2.5% debt? Hold that for life, dude. I mean, even if we get to the Fed's mythical 2% inflation target, you're still probably coming out ahead, because when inflation is 2% according to the Fed, it's actually closer to 5 or 6% according to actual inflation rates. Although now,
Steve's up in Canada.
In Canada, okay. And Canada does have the automatic refis every few years, if I'm not mistaken, because I've heard a lot about the Canada housing market recently.
He's saying every 3 to 5 years.
Every 3 to 5. So it's not really an option. So it sucks, brother. It's hard to watch that 1.5% rate go, isn't it, man? If you could keep that for 30 years, you'd be sitting pretty. Then what are we looking at? $9,000 a year more in interest. That's mind-boggling. Almost $1,000 a month. What's that? $750 a month more, just interest on the mortgage. You get nothing for that. I guess you get a slightly bigger tax deduction, so that's good. Assuming mortgage interest is tax deductible in Canada, I'm assuming it is. But man, yeah, that's just coming out of your butt, brother. That's coming out of quality of life, and there's a lot of people across the country who are looking at that, and something similar to that. And thanks again, Steve. I appreciate the super chat, and hang in there, brother. Check this one out, because this is something else that is vulnerable to interest rate shock. A lot of talk today in financial press about commercial real estate. Something we've been talking about a lot on this channel. The world's empty office buildings have become a debt time bomb. Whoa. Strong language from Bloomberg. From San Francisco to Hong Kong, higher interest rates and falling property values are bringing the commercial real estate market to a perilous precipice. Wow, a perilous precipice. This perilous precipice is predicated on preposterous property prices, by the way. But look at what they're saying here, from San Francisco to Hong Kong. Of course, this is not a U.S. problem. This is not a San Francisco problem. This is an everywhere problem, guys. There has been a major shift in the way we live and work since the unfortunate health situation of 2020. And unfortunately, all of our cities, all of our buildings were built by the old world, and now the world is different, and these prices have not adapted to that, and they haven't adapted to these higher interest rates. And well, this is the perfect storm of bad policy by central bankers. And before I get too much into this article, let me say thank you again to AK. He says, you use ticker IXIC 13498. I use NDX 14890. Okay. Yeah, I was looking at the NASDAQ composite. NDX, what's that? The NASDAQ 100, I think. But 14890, but SQQQ is the same price. Why, how, one is what one is right. You could look at either one of those. I use the NASDAQ composite when I'm looking at what the NASDAQ is doing every day. You could look at the NASDAQ 100. You could look at QQQ. You could look at SQQQ, right? There's some nuance and some difference between the two, but they track each other directionally, and the magnitude of the moves tends to be the same. So you're not going to go right or wrong either way. Let me know down below, which one would you guys like to see me use? Do you want me to use the NASDAQ composite, the NASDAQ 100? I'll leave it to you guys. I will flash the index you guys want to see. So let me know. But for now, I'm going to stick with the composite unless I hear otherwise from the people. But thanks again, AK. I appreciate the super chat, sir, and the support of the channel. And thank you to Mr. Mark, the Stump Grinder. What's going on, Mark? Nothing to say, just being a swell guy, unless I missed another comment down below. I don't think I did. Thank you very much, Mark. I appreciate that, brother. And, well, it's good to see you. Hope things in the stump business are going well. I think with a lot of the soggy soil we're getting in PA right now and the high winds, we're probably going to be doing all right in the stump grinding business out here. There's going to be a lot of trees coming down in the next few hours. All right, but let's get
into he sold enough Tesla from 6 months ago to buy a Model Y from profit, so he's doing okay.
Let's bring that one up. Where was it? Here's Mark's comment. He says, sold enough Tesla I bought 6 months ago. You have to buy a Model Y from profit. Well, my hat's off to you, Mark. I tell you, I've never touched Tesla stock. I tend to be more value oriented. So, you know, if you pay attention to valuations, then Tesla, you just never get near it. So that means I have sat out the mother of all bull runs in Tesla. I've watched it go higher, and but that doesn't mean I'm going to hate on people who make money in Tesla. Congratulations, Mark, on being on the winning side of that trade. And Model Ys, that's not a cheap car, is it? It's the 3 is the cheap Tesla, right? The Y is the hoity-toity one, the pinky's up Tesla. Do you have your pinky up in the air when you're on the steering wheel in a Model Y? Is that how that works? Yeah, I don't know if that's how it works. I'm more of an elbow out the side of my pickup kind of guy than a pinky up in my Tesla kind of guy, so I couldn't really tell you. But congratulations either way, Mark. You're doing pretty well. So, again, thank you, sir, for the super chat and for supporting the channel. All right, let's get back into commercial real estate because there were some pretty powerful numbers in this article. First of all, this article goes on for days. I'm not going to read the whole thing here. It would take 2 hours. This is a really thorough write-up in Bloomberg today. But I want to zero in on a couple of the things here. They're talking about the number of transactions, and just listen to some of these numbers. And keep in mind, guys, we're still in like the first few months of this crisis, and we can't even call it a crisis yet because it hasn't really caused any problems. We're afraid it's going to cause problems. This still hasn't showed up in the banks. Right? The banks are struggling from the rate hikes of last year and the unrealized losses on U.S. Treasuries, but U.S. regional banks have a big commercial real estate problem. It's as big as their losses from U.S. Treasuries problem, and that is what failed Silicon Valley and Signature and First Republic. But the number of transactions is plunging. We have an illiquid market, and when deals do happen, the price declines are stark. Again, so this is just early innings here. In the U.S., where return to office rates have been lower than in Asia and Europe, values for institutional quality offices are down 27% since March of 2022. Guys, it's early, and we've already lost 27%. And, you know, I saw an article not too long ago that said the baseline, I think, was 77% or 73% is what these companies were going to get for their debt. And, you know, hey, if you're talking 27% down since March, so far that number's pretty close to accurate. And that was the baseline. That was the best case scenario. When interest rates started going up, according to data from company Green Street, apartment building prices have declined 21% and malls are off 18%. Now think about that apartment buildings thing, because housing prices haven't really budged in the U.S. right now. Residential real estate is doing great. I mean, all things considered, the market is essentially frozen, but prices have barely budged. And yet, look at this, apartment building prices down 21%. That's just because of the interest rate costs of refinancing that debt. If you've owned apartment buildings and you've got a commercial mortgage on it, an interest-only mortgage, it comes up for refi, the value of that building is going to plummet because the payments on that building are about to explode higher because of what the interest rates are done. So even though residential real estate prices are yet to budge even a little bit, maybe in some local markets they're down, but for the most part they're still up, and yet apartment buildings are down 21%. And that's on top of the offices that are already down 27% and malls down 18%. These are huge numbers, guys, and we're talking about malls, apartment buildings, offices. How many of them are there in the U.S.? There's thousands of these things all over the place. And it's all sitting on the balance sheets of pensions and banks. Office prices are expected to fall more than 25% in Europe and almost 13% in the Asia-Pacific region before hitting a trough, PGIM Real Estate, a unit of Prudential Financial Forecasts. So this not just a U.S. problem, guys. 25% in Europe, 13% in Asia. And to be honest with you, the Asia-Pacific region, if you're talking about China, I think the property values are going to fall even more in China because they've got all the problems we have here of interest rates, maybe not as bad because the PBOC hasn't hiked rates as high, but they've got the property bubble to contend with over in China. Entire cities that nobody needs and lives in. So are you going to pay up for premium office space when you could rent out the empty city next door for even less? So I think even that 13% number for the Asia-Pacific region, that's probably highly conservative. It's probably going to be a lot worse than that. And you got to love this. PGIM analysts are calling this the great reset of values. It's likely to be agonizingly slow. This is not going to be a next week kind of thing, guys. Agonizingly slow. It took 6 years for office prices to recover after the 2008 financial crisis, even though that episode was centered on residential real estate. This time we think it'll take 10 years, said Richard Barkham, global chief economist for CBRE Group. I'm going to go out on a limb and say it's going to be more than 10 years. It could be never, guys. It could be never that prices for offices are as high as they are today. I mean, that's assuming we don't kick into a hyperinflationary death spiral. But let's say for a second that Jerome Powell follows through on his threats and that he's not going to automatically monetize federal deficit spending and that the Fed is not going to go burr when the government becomes insolvent. That's a big if, all right? That's a very big if, and my gut still tells me they will do that they will go burr. But let's say they don't. If the Fed comes to his senses and they stop printing money to monetize endless deficit spending, then these buildings are going to correct lower and they will never come back to these levels because these prices are not natural and they're not sustainable without an ever increasing pile of debt. And if the Fed doesn't monetize deficit spending, if they don't return to zero interest rate policy, then these prices will never come back. Again, that's a very big if. But guys, it's possible. It is one possible outcome here. They could go the route of Great Depression 2, or they could go the route of hyperinflation. They have not picked one yet. So that's one story about commercial real estate. And again, guys, this article goes on and on. They talk about San Francisco. They talk about New York. They talk about Houston. They talk about Atlanta. They also talk about Hong Kong, London. I mean, there is a lot of stuff in here. I'm not going to go through all of it, but each one of these stories is complete with anecdotes about a building going into default, about a borrower just walking away from the building, handing the keys back to the lender, about malls going bankrupt, about vacancies in offices, vacancies in stores. And this is a global problem. This is not just a San Francisco thing. I've talked a lot about San Francisco on this channel, but Houston, Philadelphia, Los Angeles, Chicago, all seeing the same thing. Go ahead, Mitch.
When Houston started coming up on the curves, you were surprised because no one ever talks about Houston.
I was very surprised. And we were talking about this earlier today. You think Houston, that's an energy town, right? That's an oil city. But they have this problem too. And you were saying, Miss, Houston's not particularly, what's the word I'm looking for? Nice.
Oh, it sucks ass.
That's one way to say it. That's not one to mince words, are you, Mish? I have only ever driven through Houston a few times. Yeah, it's a traffic jam. It's a traffic jam stuck between the coast and the desert. That's how I would describe Houston. They say Russia's a gas station in Asia. Houston is a traffic jam stuck between a nice beach and a big desert. That's sorry to all you Houstonians out there if I've insulted your hometown, but just
No, even
didn't
for
leave a
people
good
from
vibe with
Houston
me
don't
when I
like
rolled
Houston.
through. Yeah, are Houstonians as protective of their city as Texans are of their state?
No, people
Thank
from
God.
Houston don't like Houston.
Okay, thank God.
Kind of like
Otherwise, I
Naples.
made a lot of enemies. I love
Naples,
Texas.
Houston is the Naples of Texas.
The Naples of Texas. All right. I'll spare the description of Naples. I guess Naples isn't very nice either. I'm not a very well-traveled person, so I can't say so. I didn't spend any time in the Navy. All right, moving on from this one. Distressed U.S. commercial property assets rise to $64 billion. Mish caught this one this morning. We were going to talk about it in the live stream, but there was too many stories this morning to get to all of these today. But this is $64 billion. Okay, it's not yet this $1 trillion problem, but it's rising fast. All right, troubled assets climbed 10% in the first quarter, MSCI says, and another $155 billion of potential distress is looming, and that's just in the short term. Now, they talk about distress at the very end of the article. So real quick, just so you understand here, I'm going to define distress. MSCI defines distressed as properties that are either in bankruptcy, default, court administration, liquidation, or they have significant tenant distress, or if it's a commercial mortgage-backed security that has been transferred to a special servicer, which is like one step above default. Potentially distressed properties include real estate that faces delays in reselling or leasing, or has debt that's on a CMBS watch list and is in forbearance, or is delinquent on payments. So when you hear distressed, it is any of a wide range of potential issues with that debt. Currently at $64 billion in U.S., but is $155 billion on deck. Distress is spreading in the U.S. commercial real estate industry, with the amount of troubled assets climbing to nearly $64 billion in the first quarter of this year. Keep in mind, this is March data before a lot of these stories about the offices in San Fran and the malls and those two big towers in L.A. The amount of distressed assets rose 10% in the first 3 months of the year, according to a new report from MSCI Real Assets. Risks loom on the horizon, too, with nearly $155 billion of commercial property assets that are potentially troubled, according to the report. Higher borrowing costs have pummeled the commercial real estate industry, driving prices lower, causing some owners to choose to default. Now, here's where get into some of the numbers here. Retail properties, including malls, were the most troubled type of real estate, with nearly $23 billion of distressed assets tied to the sector. About $18 billion of office buildings were considered distressed at the end of March, according to the report. Now, offices are just getting started here, right? So far, the lion's share is malls. It's retail. Now, that's nothing new. We've had too many stores in America for decades, you could argue, ever since the Amazon effect took over. But offices is new, and it's already up to $18 billion. Offices, which are also struggling with weaker demand given the rise in remote work and job cuts, account for nearly $43 billion of potential distress, the most of any sector. Offices face a bigger wave of maturing debt, while distress in retail appears to be cooling, the report says. So that's good. That's encouraging, at least. Manhattan was the most active market for distressed asset sales, with $2.6 billion of deals, or 19% of U.S. transactions, in the 12 months through May. Los Angeles ranked second with $746 million of deals. That's roughly the same number as those two Brookfield towers that defaulted on earlier this year. Followed by Houston, there's Houston, Mish, with $465 million of distressed transactions, according to MSCI Real Assets. And then they go on to define it. So, we can see it. It's already a problem. As of March, which is really before the commercial real estate problems kicked into high gear, we were already up 10% year over year just in that first quarter. And there's been a lot of stories. We had that mall. We had the Union Square buildings in San Francisco. There was the Hilton buildings in San Francisco. There was the Brookfield Towers in L.A. There was PIMCO defaulted on an MBS that had something like 13 different towers across all these different cities in it. And these are all second quarter stories. So this $155 billion of potential distress, it's pretty much a done deal. It just hasn't hit official levels of distress yet. So commercial real estate, guys, they're saying there's $1.5 trillion of commercial real estate debt that is going to mature in the next year and a half in the United States. And when that debt matures, it's got to be either paid back or refinanced or defaulted on. Well, they're not going to pay it back. The buildings are not worth what they owe on them. So that's out. They could refinance them, but the only way to refinance that, the only way for that to work, is if these buildings massively jack up the rent that they're charging their tenants. Well, these buildings are already half empty. Sorry, half full. I'll do optimism today. These buildings are already half full. So how are they going to jack up the rent if already, even at current prices, they're having trouble finding renters? So that's probably not going to happen. That leaves default as the most likely outcome. And I would add one fourth scenario is the Federal Reserve very abruptly returns to zero interest rate policy. And I'm not going to rule that out this year. I mean, look at the CME group right now. Let's go to the end of the year. Where are we at? In January of 2024, the predominant level, the CME group is saying 500 to 525. So basically, exactly where we're at right now is what the interest rate futures are saying we're probably going to be at the end of the year. But if we get hundreds of billions of dollars of defaults in commercial real estate, and we start to get regional banks failing because of that, you better believe the Fed is going to go back to zero interest rate policy real fast. It's going to be the only way they can stop the commercial real estate bubble, unless everybody, all the banks and everybody gets together and decides they're just going to, extend these loans indefinitely. But there's downsides to that too. So I really think we're probably looking, that's why all of these possible rate cuts are being priced in. I think it's commercial real estate that has them looking in that direction. So that's a story to watch. It's probably going to be the big story of the second half of this year as we close out the second quarter next week. This one just hit today. United States manufacturing PMI. This is done by S&P Global, but this is the U.S. manufacturing PMI. This just came out this morning. It fell to 46.3 in June, pointing to the biggest contraction in the manufacturing sector since December, compared to 48.4 in May and forecasts of 48.5. Preliminary estimates showed. So a big miss for U.S. manufacturing. Again, anything below 50, here's the 50 line. Anything below that shows manufacturing in the United States in contraction. I just want to show you guys a 5-year chart. We have been contracting since the end of 2021, basically since the taper. Since the Fed started slowing down their rate of money printing, manufacturing in the U.S. has been declining. How about that? It's almost like the economy is hopelessly dependent on the easy money train. Weird. And, zoom all the way out here. We're already, let's go to a max level. Oh, this doesn't go back to the GFC, but we're already lower than anywhere we were in the teens. Only the height of the pandemic, the opening months of the shutdown, that is when we were lower than this. But look at some of the language that's in here, guys, and let me know if any of this sounds familiar to you, all right? New orders fell the most since December, with weak demand linked to muted customer confidence, while foreign demand was also subdued. Now, guys, it's June, and U.S. companies told us in the first quarter in January and February that they were done right-sizing their inventory, right? A lot of the big retailers, Target in particular, they said we're done with our inventory reductions and that they were going to start restocking. That has not happened. All right, the new orders continues to fall, and we're at the point right now where new orders are going to be placed for the holiday season, and they're still falling. So these purchasing managers, they're not anticipating any surge in demand in the second half of this year that's going to come in and save these companies, guys. It's still falling, and it's falling at a point when historically it would be ramping up. Also, input buying fell at the steepest rate since January, and both pre- and post-production inventories declined sharply. On the price front, cost pressures continued to dwindle as suppliers sought to boost their sales and offer reduced prices. It does not sound like inflation to me. I don't know about you guys, but on the price front, cost pressures continued to dwindle as suppliers sought to boost their sales and offered reduced prices. That sounds an awful lot like deflation, doesn't it? Deflation already happening upstream in the supply chain and the producer levels. It will take time for that to filter down to the consumer level, but deflation is already hitting some sectors of the economy. Input prices fell the most since May of 2020. May of 2020 was back when inflation was still 1%, according to CPI. Input prices fell the most since May of 2020, and selling price inflation was the slowest in the current sequence of inflation. Meanwhile, greater success in finding suitable candidates allowed firms to expand their workforce numbers. So we've got some easing of the tightness in the labor market, the imaginary tightness in the labor market. They're not having any trouble finding candidates now. Now, of course, they had to blow up my deflation narrative with the last sentence. They had to throw this one in there, but we don't do confirmation bias here, so I'll read this one. Finally, the degree of optimism was the weakest in 2023 so far amid customer hesitancy and inflationary concerns. So, inflationary concerns, that's interesting because they just got done telling us the input prices are falling and that cost pressures were dwindling and that they're reducing prices to try to boost sales. And they're also talking about, hey, wage inflation, not that big a problem because they're not having trouble finding suitable candidates. And then they come in and say, well, our customers are still worried about inflation. Well, so are our central banks. And I just think customers and central banks are wrong. That's just my take. So I'm very surprised to see that last sentence there. But guys, look, manufacturing in the U.S. falling fast. They better build that Ford EV factory and they better build that big Intel chips factory fast because we need more manufacturing in the U.S. and we're not getting it right now. Manufacturing's falling fast. All right. Markets are closed. Let's talk before we go to the markets. Let's talk about Bitcoin real quick because Bitcoin had one heck of a week. Now, the narrative that's flying around in Bitcoin right now is that traders are front-running BlackRock and this wave of institutional money that's supposedly coming in. So people are buying Bitcoin, anticipating all the big asset managers buying up the Bitcoin. That's been the narrative, all right? And that narrative holds water, all right? I would say that's reasonable. But let me just present one possible alternative here, okay? I'm not going to say that this is definitely what's happening, but this is a pretty compelling story. All right, first of all, you see what I'm pointing to here on this arrow. That is Thursday, June 15th. All right, June 15th and June 17th were very significant dates. All right, now June 17th was the day the court ordered Binance to repatriate all of the Binance US assets. Excuse me. Binance, if you don't know, they have commingled all the Binance funds with Binance US funds and with Changpeng Zhou's funds. Basically, it's all just one big slot pit of Changpeng Zhou's money. If you have an account on Coinbase, you think you have money on Coinbase, but really you have an IOU from Changpeng Zhou's personal account. That's what Coinbase is. So U.S. courts ordered Coinbase on June 17th. Here's the actual article. SEC secures emergency relief to protect Binance U.S. customers' assets. And by the way, this was posted by Bitfinex on Twitter. I've talked about this guy a couple of times before. This guy has been all over the Tether story and the Binance story for years. If you're a crypto cynic or a crypto critic, you should be following Bitfinex. And if you are like me, if you are a fan of Bitcoin, you should also be following Bitfinex because you should always listen to both sides of a trade and make up your own mind. And this guy is sharp. All right. He's an anonymous account. I don't know who he is, but he's good. All right. So I'll just read a little bit from the article and then I'll give you what this guy was saying was going to happen. And it ended up pretty much how he said it was going to happen. The order ensures platform customers can continue to withdraw their assets. The Securities and Exchange Commission today, this is on June 17th, secured an emergency relief in which all the defendants in its litigation against Binance Holding, BAM Management, BAM Trading, and Changpeng Zhou agreed to repatriate to the United States assets held for the benefit of customers on the Binance US crypto trading platform. So that basically, when you had money on Binance US was sold as this US compliant crypto exchange that was separate and siloed from Binance.com. It had its own CEO, its own staff, but it turns out it was really just a website that was a backdoor for Binance.com to do business in the U.S. There was no anything behind Binance US. It was just a website that pretty much took you to Binance.com. There was no brokerage. There was no order fulfilling. There was no market making. It was all Binance.com the whole time. So all those funds that were seemingly sent to Binance US were just going into Changpeng Zhou's personal funds. So Binance US was ordered to bring all those assets, both dollars and crypto, back into the US. All right, that was on June 17th. All right, so here's what Bitfinex said on that day. He said, Binance forced to return Binance US assets to Binance US, since in reality, Binance US was a money funnel to Binance.com's money laundering and fraud empire. He uses some pretty strong language here. But then he says, expect some sudden, massive pump and dumps. And this is where it gets pretty interesting, because something else happened here, and I got to send a shout out to Whale Alerts, who pointed this one out. All right, something that happened on June 15th, and that's why I put this arrow here on June 15th. On June 15th, 1 billion TUSD, which is this, TUSD is this stable coin. All right, it's one of the lesser known stable coins. But on June 15th, 2 days before that court order, Binance minted 1 billion TUSD. Just created it out of thin air. I'm sure there was totally dollars, wink, wink, but to back it, right? So lo and behold, on June 15th, 1 billion TUSD gets minted out of nowhere. And look what the price of Bitcoin does immediately after that day. Coincidence? Maybe. Convenient? Definitely. Very convenient if you're Changpeng Zhou and you were just ordered to bring a whole bunch of money back into the U.S., money you didn't have because you already spent it, laundered it, whatever you did with it, whatever these guys do with billions of dollars. How do you lose $1 billion? I don't know. They do it all the time. But here's, he basically said, expect some pump and dumps because Changpeng Zhou needs a new pair of shoes. CZ needs to bring money back to the U.S. The court just ordered it. So how do you do it? Well, here's what he says. Binance being court ordered to repatriate assets to Binance US is likely a huge catalyst. Binance does not have the money that they're supposed to have. The only way that they can quickly bring in some money is to run another fraud. The way that gets done in crypto is to simply manipulate the cryptocurrency markets with fake money, i.e. 1 billion TUSD being minted 2 days earlier. Dump that on the retail suckers chasing the rally, and now you have some money that you can use. I specifically warned about this before it happened. So, look, guys, the timeline, the sequence of events here, it fits. This could be what's behind this run-up in Bitcoin. Or it could be traders front-running the wave of institutional money, right? I mean, we had Bank of America Securities and Fidelity took up massive positions in... what's Sailor's company's name? MicroStrategy. It took me a minute. Sorry.
Yeah, they took screen too.
Yeah. So they took up massive positions in MicroStrategy. So, that's basically a Bitcoin ETF. So MicroStrategy, everything going on in BlackRock, there's a valid case for both here. All right. And I just want to present both possible options. It is entirely plausible, guys, and the sequence of events suits it, that this whole monster run in Bitcoin from 24/7 all the way up to as high as $31,400 we hit today. It's entirely possible that this is all one big pump and dump by Changpeng Zhou so he can use you as exit liquidity to get the money that he needs to stay out of trouble for his Binance US case. Plausible. I'm not saying that's definitely what's happening here, but hey, man, they minted 1 billion of these TUSD on Binance. Conveniently timed, isn't it? Oh, and by the way, speaking of Bitcoin, look at this. Oh, my God, this story. Shout out to Mesh, who caught this one right before we went live. The SEC approves the first leveraged Bitcoin futures ETF. The Volatility Shares 2X Bitcoin Strategy ETF, or BitX, is scheduled to launch on the Chicago Board Options BZX exchange next Tuesday, June 27th. So while the SEC is cracking down on Coinbase, while the SEC is cracking down on Binance, which I think the crackdown on Binance is totally justified, Coinbase is debatable. There's a lot that Coinbase does that I don't like, that I don't agree with. But at the very least, Coinbase has made a show of attempting compliance. Binance has not. But they've been denying a spot Bitcoin ETF, right? An ETF that actually buys and holds Bitcoin, where if you buy shares in it, you get a share in that ETF, and then you can actually redeem the ETF for Bitcoin. They have been denying a spot Bitcoin ETF for what, 10 years now? Grayscale has been trying to convert GBTC, the Grayscale Bitcoin Trust, from a trust into an ETF so they can use that arbitrage method, the redemption arbitrage, to keep the net asset value in line with the share price, which would result in, you could argue, would result in a healthier market for Bitcoin, certainly a healthier stock market. Well, the SEC under Gary Gensler, who is a freaking stooge, if you ask me, the head of the SEC has denied that for years, saying, oh, there's too much risk of fraud in the Bitcoin space, namely because stable coins run a risk. And so they've denied this spot Bitcoin ETF, which is just a derivative of Bitcoin. All right. We can't have a derivative of Bitcoin because there's risk of stable coins. But at the same time, we'll approve a 2x Bitcoin futures ETF, which is a derivative of a derivative of a derivative of Bitcoin. That they'll apply. That they'll grant. Suddenly, there's no tether risk. What happened to the stablecoin risk to Bitcoin? Or maybe because a 2x leveraged Bitcoin futures ETF is a tool similar to the SLV and similar to all these other ETFs that institutional money and big market makers can use to try to wag the dog to try to control the price of Bitcoin. It's easier for big money to manipulate leveraged ETFs than it is to manipulate a spot ETF that can actually be arbitraged and be redeemed. So while the SEC is done killing or has been spent the last 10 years denying what could arguably a legitimate spot Bitcoin ETF. I mean, it's not, I would never invest in a spot Bitcoin ETF, but a lot of people might. And, you know, if it ever gets out of whack, you could actually make money redeeming and arbitraging it. It's actually not a bad idea. But they'll go ahead and approve this garbage, a 2x leveraged futures ETF. The SEC is just, it's run by institutional crooks, guys. It's unbelievable that this gets approved before a spot Bitcoin ETF. It just defies logic, but there it is. There it is in print, guys. A 2x spot Bitcoin ETF. And there was a quote down here. This is from Eric Balkunas. I don't know who Mr. Eric is, but he's quoted in this article. It's pretty good. When we look back on the Bitcoin ETF saga in 5 or 10 years, this will be one of the most ridiculous aspects. A 2x leveraged futures product launching before a straightforward spot ETF. Wild. And that's right. This is lunatics running the asylum. Absolute madness. All right. Am I caught up here? No, I'm not caught up. I got my man Dan is in the house. Hey, Dan Hadeen, what's going on, brother? He says, first of all, thank you, Dan. He says, remember the shiny, buy the dip. Thank you for all the great info, Jack and Mish. Remember the like button. Dan, I like the shiny. And look, you know, I buy silver. I buy gold, I buy silver, and I buy Bitcoin on the regular, regardless of price, because those are not investments I'm making to try to run up my nominal US dollar wealth. Those are investments I'm making to unbank myself, to try to divorce my personal outcome from these markets that are run by these guys who approve this kind of stuff, like 2x leveraged Bitcoin futures ETFs, right? The more physical gold and silver you hold, the more Bitcoin you hold, the more protected you are from crap like this. All right, they're trying to take away the off-ramps, or they're trying to control the off-ramps of fiat currency. Now, they already manipulate the price of precious metals. We already know that. They're attempting to manipulate the price of Bitcoin, although, you know, some of the fraudsters like Changpeng Zhou, for example, appear to already be doing a pretty good job of manipulating the price of Bitcoin. So pick your poison in that department. But I still believe that these are good ways to protect your wealth from the traditional finance system. And, you know, if you think Sam Bankman-Fried is bad, if you think CZ is bad, you're going to love Jamie Dimon and Larry Fink, because they're just, you know, they just are better dressed and don't have the stupid hair. That's the only difference. They're bigger institutional crooks. I mean, JP Morgan fined again today, or was it today or yesterday? They deleted 47 million emails, and they got fined like $4 million for it. Some slap on the wrist fine. And how many times a year does JP Morgan get fined for breaking the law? Nobody goes to jail. If they do, it's some low-level trader on a desk that gets a slap on the wrist sentence. And
hey,
institutional
Jack.
theft.
Yeah, I was going to say, Divvy is in the chat, and he's not losing his mind. So you did a good job there with Bitcoin.
Oh, we got Patrick is in the house?
Yep.
Patrick Hakeem? What's going on, Patrick? Patrick Hakeem, a.k.a. the Divvy Daddy. We've had him on the channel. Patrick, we are going to get you back on the channel, brother, soon because I'm sorry, I got a frog in my throat. We are going to talk about there's a lot going on in crypto right now. And, you know, it's not my strong suit. I don't live in this space all that often, so I get through it. I have a pretty good nose for fraud. Let me just say that. And I can tell you what's going on at Binance and TUSD stinks, just like what's going on with this 2x levered futures ETF stinks. But we're going to bring Patrick back on maybe over the weekend. I'm heading away for a couple of days, so it's going to be hard for me to get anything done this week. But Patrick, we'll talk, brother. We're going to bring you back on the channel to talk about it because history is happening in cryptocurrency right now. There's definitely history is being made. The regulators are trying to take it. They're trying to take it over. They can't kill Bitcoin, but they can sure as heck kill the off-ramps and the on-ramps, and they can control the flow in and out of. And they're going to try. They're not going to give up their power willingly. So we are watching history in the making.
Would you say they mounted up?
What's that?
Would you say they mounted up?
Would they melt it up?
No, mounted up. Regulators mount up.
Oh, regulators mount up. Wait. Young Guns, right?
Young Guns.
All right. Don't 80s movie quote me, Mish. That's a great movie, by the way. Now I'm going to have that Bon Jovi song from the soundtrack stuck in my head all day. Oh, not another Bon Jovi Friday. Good God. Hashtag Bon Jovi Friday. All right. Thanks again, Dan. I appreciate that. And yes, don't forget the shiny. I definitely like the silver. Actually, I got my shiny right here. I got my America 10-ounce silver bar. I keep that handy just to keep me grounded. And I just like the feel of it. I just love the feel of a 10-ounce silver bar. So hopefully get some more of that coming soon. Thanks again, Dan. I appreciate that, brother. Thank you, guys. And thank you, Patrick, for weighing in and for not crucifying me. I'm sure I said something wrong in there in my whole spiel about Bitcoin, but let's see what we got going on in the markets right now. They are closed. The S&P ended up closing down 33.7 points, about 0.75%, off the lows of the day, but just barely, closing at 43.48. The Dow closed down 219 points, down about 0.65% at 33,727. And the NASDAQ Composite ended up closing down 138, or a full 1% at 13,492. So Jack's SQQQ calls are looking pretty good today. That's good. And, well, that's about all we got for today. Mish, you got anything you want to throw in there, brother, before we wrap it up?
I was muted. I'm not muted anymore. I think it's going to be volatile for a while. I think that the news out there hasn't really changed, but the feeling changed this week. So we'll see how that goes.
Yeah, you definitely felt the change in the air this week. I think Powell had a lot to do with it. I think that, look, guys, we got Wall Street analysts downgrading Tesla, citing valuations this week. That does not happen. Tesla and valuation do not get mentioned in the same sentence ever. So, my man Mark, by the way, bringing him back up here, Mark the Stump Grinder, kudos to you when you got out of Tesla when you did. You may have gotten out right at the top there because, you got those two downgrades this week. And Tesla held up remarkably well yesterday, all things considering, or considered, but I think it was down about 1% and change today. So, congratulations, Mark, on timing that top pretty well. When you see people talking valuation and Tesla in the same sentence, that's a hint that the market is near a short-term top. Also, that CNN fear greed indicator, that is a very good indicator, guys. It calls reversals pretty accurately. When that thing drifts into extreme greed, it means the market is about to turn lower. When that thing goes into extreme fear, it usually means the market's about to turn higher. And usually it doesn't go into those categories unless everybody, I'm talking about like your hairdresser and your cab driver, are talking about how the market is going to crash or about FOMOing in a Tesla calls. And that's when you need to be the most vigilant for the tops or the peaks in that emotional behavior, because the CNN Fear Greed Index has nailed the top a couple times in a row now. So we were in extreme greed. We got up to 83 last week. When I saw that hit 83, that's when I pulled the trigger on those first SQQQ calls. And so far that trade is working out all right. So the question is when to get out. When to get out. We're going to be looking to call the bottom this time. It's something we're going to work on. Jack, hey, it's right here. Perma-bear. Jack is a perma-bear. I don't really do optimism, but I believe we are turning lower right now, and I am going to be hyper vigilant for signs of a bottom as we move lower. I'm going to try. I don't usually do optimism. It's a little outside my comfort zone, but hey, I promise a genuine, legitimate effort is going to be made. All right. I want to say thank you to my moderators for everything you guys do for the channel. Mish, M&J, all you guys. Tiggy, if you're in there today, thank you guys for everything you do. Also, thank you to my Patreon supporters for everything you guys do for the channel. Thank you for the super chats, for your support. I appreciate that very much. Also, thank you, Patriot Gold, for sponsoring this live stream. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Have an awesome weekend, everybody. And until next time, live small and dream big.